Deep Dive, Sable Offshore. Part 7, The Reluctant Banker. The ExxonMobil Safety Net. The Exxon note is the core risk, and many bullish write-ups understate it. VIC commentary has correctly focused on this issue. The maturity is clear. Sable extended its deadline to March 31, 2027, or 90 days after first sales, whichever is earlier, by raising $250 million in November 2025 at a much higher interest rate. As a result, the real clock starts once oil sales begin because the company must refinance immediately to avoid crushing interest costs. The downside risk is real. The purchase agreement with Exxon has teeth, and the restart failure date has already passed. As of early January 2026, Exxon sits in a position of leverage with the contractual ability to take the asset back and effectively force a wind-down. Even if Exxon has no interest in operating these assets in California, that option gives it negotiating power. It can demand higher interest, fees, equity, tighter covenants, or more control in exchange for time. Any upside depends on how this leverage is resolved. This section of the Sable Offshore story is the one that separates casual bulls from the realists, and it's where the bear case gets its teeth. Most upbeat write-ups hype the reserves, the federal wins, PHMSA permit, Ninth Circuit no stay, the dual paths, pipeline plus OS&T, and Flores' track record. They treat Exxon as a background lender, but Exxon isn't just the seller. It's the senior secured creditor with a senior lien on essentially everything, and it's wielding that power aggressively. The financing terms are the fulcrum. Everything else, permits, production ramp, court rulings, only matters to the extent it strengthens SOC's hand in dealing with Exxon. The real risk isn't geology or permits, it's Exxon. Sable bought time by raising money in late 2025, but it came at a very high interest cost, so the moment oil sales start, the pressure to refinance becomes immediate. Exxon isn't just a passive lender in the background, it holds the senior claim on the entire asset and has the contractual right to take it back if things go wrong. That gives Exxon enormous leverage in negotiations, whether it wants higher interest, more equity, tighter control, or all of the above. This is where the bull and bear cases truly split. All the permits, court wins, and restart plans only matter if they improve Sable's bargaining position with Exxon. If they don't, Exxon, not shareholders, decides how much value survives. The maturity clock is real and it's ticking differently than it looks in November 2025. Amendment announced November 3rd, effective after conditions met around November 24th. Sable bought time. They raised about $250 million in equity, private placement at about $5.50 share dilutive and painful, to satisfy the condition for an amendment to the Exxon senior secured term loan. That pushed the maturity to the earlier of March 31, 2027, or 90 days after first commercial sales of hydrocarbons. The image shows Sable walking across a narrow bridge between two cliffs. On the left is financial distress, the risk of default if the loan wasn't amended. In the middle are the costs of survival, negotiating an extension, accepting a much higher 15% interest rate, and agreeing to a minimum cash covenant. On the right is temporary stability, not success, just avoidance of default. The key point the picture makes is that the bridge only exists because Sable paid a high price, dilution and expensive debt, and it's narrow because one misstep sends them back toward the cliff. The higher interest doesn't solve the problem, it just buys time while making the ultimate payoff harder. On paper, March 2027 feels like breathing room. In practice, it's a double-edged sword. The moment sales start, whether via pipeline restart or OS&T tanker offload, the fuse shortens dramatically 90 days to pay off or refinance the whole thing. About $900 million plus principal with accrued PIK interest. Sable can't afford to run at 15% interest long term. That would add roughly $200 million plus in extra carry by 2027, pushing the total toward $1.1 billion plus. They need to refinance well before then, ideally right around or shortly after first sales. Sable didn't fix its debt problem in November 2025, it delayed it. By raising $250 million and agreeing to much higher interest, the company pushed the deadline out to March 2027, but only on paper. In reality, the moment oil sales begin, The clock speeds up because Sable has just 90 days to refinance a very expensive loan that's growing fast. Keeping 15% debt outstanding would bleed hundreds of millions of dollars, so refinancing quickly is mandatory, not optional. The takeaway is that the real deadline isn't 2027. It's shortly after first oil, when Sable must convince lenders to refinance or face losing control of the asset. The partial restart already triggered acceleration back in May 2025, when Harmony restarted and flowed to LFC storage, not yet commercial sales. It tripped an acceleration clause, maturity snapped to January 2026, Sable couldn't pay, so they negotiated the extension. But it cost them interest up from 10% to 15%, compounded annually, PIK at election, plus a new covenant for minimum $25 million unrestricted cash at month end. Every month they miss that, risk default. At a $25.40 monthly burn, cash is not a vague concern. It defines the timeline. Even after the late 2025 equity raise, the practical runway is measured in months, not years. Absent meaningful revenue or new financing, Sable risks tripping the $25 million minimum cash covenant and entering a creditor-driven endgame before the legal process naturally resolves. When Sable restarted part of the system in May 2025 and sent oil to storage, but not to market, it accidentally triggered a clause in its loan that pulled the debt deadline forward. Sable couldn't pay, so it had to renegotiate. The price of that extra time was steep. The interest rate jumped to 15%, and the company agreed it must always have at least $25 million in cash. Miss that cash minimum even once, and it risks default. In short, restarting without selling oil made the debt more expensive and put Sable on a very tight monthly leash. The restart failure date passed. Exxon now has the reversion hammer. The original purchase and sale agreement, PSA, defined a restart production deadline commercial sales by around March 1, 2026. Some early filings referenced January 1 or similar, but March 1 is cited consistently in later disclosures. Full commercial transit hasn't happened yet. Onshore lines still not moving oil commercially per early January 2026. Admissions in court docs. Technically, the reversion option is live or imminent unless waived/extended. Exxon doesn't want the assets back. They spent years trying to exit California offshore, but they hold the cudgel. They can threaten reassignment without compensation, forcing wind down, or blocking further extensions unless terms improve for them. It's negotiating power, not desire to operate. Sable was supposed to reach full commercial sales by around March 1, 2026. That hasn't happened yet, which means Exxon now holds a powerful option. It can legally take the assets back or threaten to do so. Exxon doesn't actually want to operate these assets again, but that's not the point. The threat gives Exxon leverage in negotiations. It can demand better terms, more control, or more value in exchange for extending deadlines. This isn't about Exxon wanting the oil. It's about Exxon using its contractual rights to dictate the outcome if Sable can't move fast enough. Exxon, as the reluctant banker with asymmetric leverage, Exxon isn't hostile for fun, they're rational. They want their money back, plus premium for the risk, and they can wait. Sable can't burn is $25 to $40 million per month range, liquidity tight around the $25 million covenant. Exxon has already extracted concessions, $4 million per month payments, starting about June 2025, until certain permit transfers complete, operating permit, etc. Steady cash drain, P&A, plugging and abandonment, bonding. $350 million financial security, bond/LOC, now due. 3 business days after loan maturity. March 31, 2027 or 90 days post-sales. Up from original timing. Exxon can push it to $500 million under conditions. Every delay or setback gives Exxon another opening. Higher rates, fees, tighter covenants, more dilution, warrants, or governance tweaks. All of it comes out of equity value. Exxon is playing hardball because it can afford to, and Sable can't. Exxon isn't trying to punish Sable, it's protecting its money and getting paid for the risk. While Exxon can wait, Sable is burning tens of millions of dollars a month and has very little cash cushion. Exxon has already locked in monthly payments, accelerated large cleanup bonding requirements, and moved deadlines forward. Each delay gives Exxon more leverage to demand better terms, higher interest, more fees, stricter rules, or more ownership. Every one of those concessions reduces what's left for shareholders. The longer this drags on, the more value shifts from Sable's equity to Exxon. Bulls say, clear hurdles, then sales start, then massive EBITDA, the refinance in strong markets, and finally, equity explodes. Bears counter, even if ops succeed, Exxon controls the refinance conversation. No junior lender touches this while Exxon's senior. Refinancing requires Exxon's cooperation, takeout or subordination. If markets are soft or Sable has weak alternatives, Exxon dictates punitive terms, transferring upside via fees, equity slices, or other grabs. Believers in the company believe that once oil sales start, the cash flow will be so strong that refinancing becomes easy and the stock takes off. Bears argue that this ignores who's really in charge, Exxon. Because Exxon sits at the top of the capital structure, no new lender will step in without Exxon's consent. Even if operations go well, refinancing still requires Exxon to cooperate. If markets are weak or Sable has limited options, Exxon can set harsh terms that shift much of the upside away from shareholders and toward itself. Equity only wins if Sable arrives at the refinance moment with real bargaining power. Durable federal path. PHMSA renewable OS&T approvals. Multiple monetization routes, external lender interest, and no major incidents. That weakens Exxon's squeeze incentive. They'd rather get repaid cleanly than force a mess. This isn't about Exxon being mean, it's about relative power. The loan is the existential fulcrum. Production headlines matter, but refinancing terms matter more. If Sable gets there with options, Trump-era federal tailwind helps, Exxon likely facilitates an exit. If not, if delays persist, liquidity bites, or alternatives fizzle, Exxon wins big, and equity gets vaporized. Default, reversion, wipeout. That's why this remains investable, but never comfortable. High variance bet on Flores, threading the needle legally/operationally while diffusing the debt bomb. The bear case is structurally strong because Exxon controls time, and time is SOC's enemy. Classic special sit, asymmetric upside if the jockey outmaneuvers the banker, but razor-thin margin for This is Avi. Like and subscribe. On to the next.